Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions. Hey, Reluctant Preppers, if you haven't heard, we've already started our monthly 1-ounce U.S. Silver Eagle thank you gift to one active Patreon subscriber each month, signed by your host, Dunnigan Kaiser. And you don't want to miss out on that.
Please help us grow by subscribing today at patreon.com/reluctantpreppers.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Probably do the same thing, Dunnigan.
As long as we both do it, it'll work fine. It's when one of us does it that's the problem. Okay. Welcome back, Reluctant Preppers. We're glad to have this returning guest. Lynette Zang is the Chief Market Analyst at ITM Trading, and she's wildly popular with our guests, with our viewers here on Reluctant Preppers, who like to hear her perspectives on what's going on in the broader markets, as well as get updates on her own urban farming and preparedness steps that she takes in her own life. Lynette, thanks for joining us again here on Reluctant Preppers.
Always, always, always a pleasure, and I'm really flattered that your viewers enjoy my opinions.
They enjoy many different aspects of your research and the data-driven approach that you bring, as well as just kind of the commonsensical, sort of from-the-gut explanation about what things make sense and what things don't make sense. You and I were talking just now about a phenomenon that you've been researching for your book that has to do with a shrinking buyer base, and it reminds me.
Right.
It reminds me of when people have talked about, and this happened back in the .com before the .com collapse as well. And it may be a completely different analogy, but the structure of the leaders versus laggards in the equities market, for example, where the overall index kept marching greater and greater and greater on upward for, in that case, it was the NASDAQ, right? And
right.
But in fact, if you looked at it, it was just these few, the four horsemen of the, Amazon and Microsoft and eBay or whatever, that would just keep pulling the market forward. That was back in the .com, and now again, it seems like when you look at the broader market, it's not keeping up with these leaders. But you're looking at a different phenomenon. So go ahead and enlighten us.
Correct, but that's not actually applicable to what I'm talking about,
Yeah.
but that is definitely a phenomenon that we have been experiencing in this market, where what's been pushing it up has just been a few stocks, and mostly technology, Apple, Facebook, those. On the flip side, what I'm talking about, the shrinking base of buyer, has more to do with why we have the level of volatility in these markets that we have right now. And basically that, the growing base of buyer, if we go back to the availability of credit to the masses, so that started in the 20s when they started to turn us into consumers rather than manufacturers and farmers. And then in the 50s, when we got the very first credit card that was not tied to any underlying asset. But mostly since the 70s, when we shifted to pure debt base and the availability of credit for everybody expanded. For corporations, prior to the 70s, there were defined benefit contributions. So you had the corporations as a buyer of stocks and bonds, but they also ran all of the risks inherent in a market and the bust of a market, and they were still responsible for the payout, defined benefit. In the 70s, that's when they developed the IRAs, and then a little bit later the 401ks, which are defined contributions. In other words, what you're putting in is defined.
Right.
What you get out can be anything at all.
Past results do not guarantee future success. Right?
That's the truth. But they can Two, because what we've seen time and again is that once the risk has been transferred to enough of the public, it's typically the public that eats it when the markets implode, because it's really a risk transfer mechanism. So as long as the credit kept expanding and Wall Street was free to create all of these new products, that's exactly what they did. So their buyer base were market makers, Wall Street firms whose job was to go in and to kind of catch a falling knife when the markets were dropping and put a floor underneath it, hold that inventory, take that inventory off the market, hold it, and then sell it back into their client base as necessary or as they had the ability to do it. But as Wall Street market makers, they had to create that floor. Then, of course, after Black Monday in '87, they created the government's working group on financial markets, the plunge protection team, and their job, the Treasury was obviously part of that, funded putting support underneath those markets. Since 2000, we've seen a decline in the market makers, like a decline by 70%. So of those firms that would go in and buy falling stocks or bonds on the secondary market or falling bonds, those numbers, the amount of that activity has dropped over 70%, as since the crisis in 2008, we've had a rise in passive investing, so a rise in computer algorithms. So even though volume, the number of shares that are traded, are roughly 70% less than they were in, say, 2009, out of that, 90% of the remaining volume are generated by computers. And computers, the formulas that are set to trigger when a stock or a bond hits a certain price, then the next thing, if it's on the downside, then they're triggered to automatically sell. And because so much of this movement has gone into that passive investing, you also see what they call stock clustering, where you'll have a whole bunch of ETFs and every single one of them holds a gazillion shares of Apple or a gazillion shares of Facebook. So on the way up, when that's triggered, it pushes the stock price higher. But as we've been witnessing, particularly since February and all the volatility, because there's not really an active market, there's fewer buyers in this market. On the downside, on the sell side, that's what creates those flash crashes. Now, what I find really interesting about this narrowing base of buyer, remember, when you're going to have a market that you want to support, you want retails, you want banks, you want market makers, you want people putting their money. I mean, it really lies on the shoulders of the individuals, because they've got to make those deposits into those 401ks and those IRAs. The city and the states make the deposits mostly in for the pensions, and then of course some corporations do as well. But what's really been happening is, little by little, the normal support in the market, like the market makers, have gone away, like the interbank lending. Yeah. The interbank lending, which we've talked about many times on your program, was a key generator of liquidity in these markets. Banks loaning to each other. Well, they're gone. They're gone. So can you see that there have been two huge pieces, and there's more, but two huge pieces that have created market support that do not exist, or I shouldn't say that. They have been so minimized that during this next flash crash crisis that comes up, they can't ratchet that up fast enough. So what's left are, like the plunge protection team, which is funded by the Treasury and also includes the central bank and the chair of the CFTC and the chair of the SEC, but you just don't have as big a pool of buyers. Did that make sense to you?
Yeah, and when you say the reduced pool of buyers, what specific evidence? You mentioned the reduced volume of transactions by market makers, for example, but what other data do you go? Because I know you make these conclusions based on data. Where do you go to get the data to help you conclude about the reduced pool of buyers?
Well, actually, it's kind of hiding in plain sight. The Treasury has talked about it quite a bit. The IMF has explored it because it's not just a U.S. piece. It's actually a global piece. But you can also just simply look at the volume data. And then, there's lots and lots of data on the rise of the passive investor, the ETF market, which even though that started prior to 2008, it's gone up, I think, over 6 times. I could be off on that. I think it was about, don't hold me to this, but about a half a trillion in 2008. And I think it's, it's just about 2 trillion were the most current data that I saw. So it's gone from a half to 2 trillion just since 2008. At the same time, the managed investing, so the active managers, that's declined by about that same amount. Okay. Plus, so that there's lots of data on that shift from active management, and subsequently, Wall Street has fired a lot of the human, whether they're in the front office or trade on the trading floor, because they're allowing computers and algorithms to perform a lot of the functions that humans once performed, which means that, we've seen it. We've experienced flash crashes in 2010. These things didn't happen before that, right? So 2010 was that 1,000-point down day, and they stopped out trade. They halted trading, and we have a lot more of that trading halts than we realize, because they can happen for seconds, so you might not even see it. And you can find that data. That's another thing, though, that I look at are the trading halts. Trading halts will be called when certain parameters, most of it pre-market action, are met, and they'll stop the stock from trading. A halt is a stop. They stop the stock from trading until the algorithms can get caught up and to calm the market down. So that prevents a lot of visible things, like that you would see if you were watching CNBC, but that's something that's easily Googleable as well. It's called trading halts. And if anybody wants it, any of this documentation, first of all, I've talked about it in my other videos, so we have all the links, we have all of the documentation for this. But the shrinking base of buyer has really, nobody's talking about it, but you can go in and you can look at high frequency trading, which was huge when there was lots and lots of volatility in the markets. Now, that didn't really create liquidity. It did create volume, because high frequency trading was all about getting in front of a trade and picking up a penny here or a penny there. It was just about making pennies. But you do that enough times, now you've got billions and trillions. But since the central banks have really created this low, up until February, the end of January, this very low volatility environment and essentially a one-way up market, other than a few times when we've had some breakdowns, a lot of those high-frequency trading desks have gone out of business too. So, this is just all really, frankly, easily available data if you're looking for it. But it's not something they're going to want you to understand, because you need a lot of hands. There has to be a buyer on the other side of the trade when you want to sell. And it's not just that these algorithms like the ETFs, exchange traded funds, which are really just a derivative. You don't own the underlying, whatever it might be, whether it's a stock or a bond or gold or silver. If you own a share in an ETF, you do not own the underlying asset. You just own a contract. And this year, they are being granted an exception so that they don't have to hold any cash. So go to Yahoo Finance, any ETF that you want to, put it in there, look at the holdings. And what you're going to see is they may be sitting on 99.98% of stocks or 99.98% of bonds, or maybe a balance of the two. But you're not going to see any cash holdings. They may be holding derivatives, which would be classified as other. But they're not holding any cash because legally they do not have to pay you out in cash. Actually, legally, they are merely required to pay out in kind, which means they can create another ETF to pay you out in. Plus, they're not even really paying you out because it's only authorized participants like, say, Merrill Lynch, Bank of America Merrill Lynch, or JP Morgan Chase, or Goldman Sachs, or one of those guys that actually might, and that's a might, have access to the underlying assets like GLD, like gold in GLD or silver in SLV. But legally, they don't have to pay them out in cash. They could pay them out in kind. So legally, the ETFs do not have to hold any cash or any short-term, highly liquid instruments that they can convert into cash within 3 days. It's an exemption. They don't have to. So what if you bought your ETFs from Merrill Lynch and there's a run on the markets? Well, Merrill Lynch is not getting that paid back in cash. They're getting paid back in another share of ETFs. So how do you buy that? What if Merrill Lynch has already used up all the cash that they had available, and Bank of America, because we know all of the banks are super leveraged, well, bail in. So we're inside of an environment that is documented by the IMF has done a lot of reports. There's lots and lots of reports on this. It's just that you have to look at each individual area, and it's very, very cumbersome to do. But like I said, I'm working on this chapter in my book, and so where I was talking about it from this level, I've now gone into it on this level. And I will be doing a lot more videos on this because, you know, if you actually realized if you are comfortable enough to hold your wealth, or you don't have any choice, because if you've got a 403B or a 401k, yep, or certain other instruments, you may not be able to liquidate. Right? But either way, just think about it logically. If there are fewer and fewer people or entities that are willing to buy what you want to sell, what happens to the price?
And the lack of liquidity is the thing that's really got me chills from what you've been describing too, because everybody goes through the assumption that, well, even if I'm not the first person to want to sell, I should be able to find plenty of buyers when I do want to sell, because that's what they think is there's always going to be plenty of buyers. But if there's already this shrinking buyer pool, then what does that do to liquidity? Should there be a desire to head for the exits? And that's sounds seriously increasing in risk.
It absolutely is. And what people don't realize is that ETFs are a new experiment. Really, they've risen inside of an environment where you had global central banks creating a one-way supported market. And now those same central banks talking about base of buyers those global central banks are attempting to, and I really put this in quotes, normalize. So they're not buying as much as they once were. That's a shrinking base of buyer.
Mm-hmm.
And that's a key base of buyer. Unless you think that they won't come back in and do another round of QE, hey, let's take a look at Japan, right? I mean, they are a case in point. They are now 3 lost decades.
Mm-hmm.
And they've QE'd into oblivion. They're in negative rates. They own, 90% of the ETFs on the Nikkei? I mean, come on. It's pushing on a string.
It's interesting because when we had you on at the end of January of this year, right at the beginning of February, is when the title of that talk with you was "The Banks Are Getting Out First, Where Did All Our Money Go?" And it sounds like the phenomenons that you're describing there that have plagued us all year of this volatile market, and now you're talking about having dug into it further and found this shrinking buyer pool. Very concerning. I should mention, and I should have mentioned this in the beginning, today is Tuesday, November 13th, 2018. So, and if we could switch, I know we have limited time today, so if we could switch to some viewer questions,
sure,
that'd be great, because a lot of people have submitted, and so we'll only be able to hit a few of these. This is a good one, and I watched this interview that they're referring to. Woodbridge says, "Hi, Lynette. I enjoyed your recent boots-on-the-ground interview with Fernando Aguirre, in which he had lived through some monetary collapse in Venezuela, I understand. What was your greatest insight from this interview?"
Wow. I'll tell you what. There were a couple. Number one, I just got chills. Number one is that you might be safer in a city than out in the country, unless you are really, 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 really out so far that no transport vehicle can get there. So that was actually pretty shocking, because I would have personally thought you would have been safer out in the country. Mm-hmm. But also, okay, fine. I still haven't done this yet, but I am going to get a gun, and I do know how to shoot. I just really hate that. I really just hate that, because I'd rather feed you. Okay, I'd rather take care of you than I would shoot you. But if somebody is really coming to jeopardize the lives of people that I know and love, so that really is that you do have to. That is part of the security. I was avoiding it. But after my conversation with him, I'm like, okay, I can't avoid it. I don't want to do it, but.
Did he give some key, and I didn't catch that part of the interview, did he give some key bullets about, sorry, no pun intended, about the comment about living out in the city being safer than the country? Is the idea that you're able to get kind of safety in numbers, or lost in the crowd, rather than sticking out like a sore thumb or something, or what's the thought there?
Well, it is about the law of numbers, but when you're out in the country and your neighbors are distant, then they can really hold up there and do whatever they want. And so, these bad guys can do really bad things and nobody would even know it. Whereas when you're in the city, you just don't have that same level of invisibility.
I see. Wayne,
yeah, I mean, his book was really an absolute point by point how to.
So people
based
check
on
out
his personal experience.
Check out that interview, because it is a look ahead from someone who has been through some tough experiences, and we can always learn from that. Wayne Collins asks a question, a two-part question. One is, after the crash of the current financial system, if there's a window of opportunity in which to purchase real estate at reduced prices, but when the window closes, real estate prices will climb dramatically along with everything else as hyperinflation sets in. Is that question?
No, the opportunities are most likely to present during the hyperinflationary and reset event, because all of that debt resets, people won't be able to pay it, so all of that real estate comes back on the market, and that's really what pushes the prices down. But we're not likely to get what he's referring to, which is a V-shaped recovery, which is actually something I'm talking about this week as well. Insofar as there just won't be a huge broad base of buyer. So what it'll be more like is like a cup, that cup formation that I talk about all the time. So, that's what you're really looking for. You're not looking for this, the V shape. That's not stable. You're looking for a cup shape, so there is time to accumulate. And, honestly, if you get in at the very bottom, just like if you get out at the very top, that's luck. I don't really care so much about that. I just want to accumulate. As long as it's undervalued, I'm going to accumulate, even when we break out of the cup.
We've got a question from Bruce Martin, who's talking about basically owing about 1/3 of the value of his home currently. And if he were to come into some cash in the next several months, would he be best served to pay off the mortgage immediately or buy a large number of ounces of silver, wait for it to appreciate, then sell a portion of silver to pay off the mortgage? Of course, that's getting pretty detailed timing-wise on financial advice. But in principle, what are the main principles at play there?
Well, I'm first going to say that everybody needs to do what they're comfortable doing. For me, I still do have a small mortgage on my property, and I'm choosing not to pay that off, but rather I've actually bought growth gold collectible coins to accomplish that because I don't need as much. The biggest challenge with silver is how bulky it is.
Yeah.
And that makes it really hard to pay off a large something or convert into a building. For me, gold does that way, way better. So, and part of the strategy is how much gold and what kind of gold you need. So we look at how much your balance is. And so if it's, let's say you owed, just to make my life easy, you owed $90,000. Well, you could pay that out in $90,000, or maybe 10 gold coins would do the trick. And maybe that's going to cost you, what? 15,000. If you do the collectible ones, maybe 20. Right? Well, I'd rather pay off my house with 20,000 than I would with 90,000, because the 90,000 right now, those dollars have more value than they will down the road. So take those overvalued dollars, because they're going down in value. Take those overvalued dollars, buy undervalued gold and silver. But if you want to pay off your mortgage, it's going to be easier with gold. And that's how you buy low, sell high. So you're selling high, the dollar's overvalued, you're buying low, gold is undervalued, and then let that reset happen, get the notice from the bank, and bam, pay it off. Whole lot cheaper.
I wish that they could put the bam into the legalese on the bank letter that you get. Here's one from.
Yeah, they put the bam on it, but not in a good way.
Not in a good way. This is from Awake in Carlton, who asks, please give an example of how other countries' debt cost has risen due to the surge in U.S. interest rates and the strength of the dollar. For example, what was their interest rate when they borrowed compared to now? I think you've talked about this in the past.
We have, because, it's basically been a quote-unquote dollar carry trade. Some of you may have heard about the yen carry trade, and that's when the dollar was weaker against those other currencies. And interest rates were, anchored at zero. And so a lot of governments have actually borrowed in terms of dollars because it was cheaper, but a lot of corporations have also borrowed. Neither one of them earned dollars. So as long as the dollar was weaker against their currency, it was super cheap. And the difference between the two, converting their currency into dollars, well, that made that even cheaper. But now the dollar has strengthened. They still have to go out and buy dollars to satisfy that debt. And even if they roll it over, the interest rates globally have risen, so that debt is more expensive. So the dollar strength is because the federal against other currencies, right? Not in purchasing power value, but in relation to other currencies, that's because of the rising interest rates of the Federal Reserve, because other buy our treasuries over, say, the ECB's government bonds, because they're going to get paid more in terms of dollars. So it attracted more, but it creates a problem for anybody outside of the U.S. that has debt and has to service that debt in terms of those dollars when they originally laid it in at a much lower level. But I can't tell you what those exact numbers are. First of all, because I don't have a general charter graph in front of me, but we have seen that difference and that shift. And also because a lot of them are done outside of the regular banking system, in the quote unquote shadow banking system, and we don't necessarily have that data. But we do know that trade is unwinding, and that is really, really dangerous.
We know, I wish we had more time because there's a lot of other questions here that I wanted to get to, but we're not going to have time. So I'm going to jump to this one since we only have a couple minutes left. Jeff Harbaugh asks, please give more information of your non-financial prepping. And you know that's always the thing I always come back to at the end is your urban farming and so on.
Well, I'm very excited that I have my very, very first passion fruit.
Oh, wow.
Which, I know. I've tried that like so many times. But this time, one of the guys that helps me on the farm, well, he does it. It's not like I don't go out there and do it. He's been hand pollinating it.
Oh, my.
To make sure, and we finally have liftoff. So, yeah, I'm actually right now, we are drying roselles, which are super nutritious, from the hibiscus flower. We're in Arizona, so I'm still able to have a lot of things fresh, but we are now going into winter. So we're doing a lot of storage on those things like my moringa. We're starting to dry the moringa and the holy basil so that I have it off season. And here's the big one, and I'll take pictures of this and send it. We are also converting the garage. We're going to have a big space, a cool room, but we're setting it up for indoor growing, year-round indoor growing, because of the climate changes and different things. It seems like we should have the ability to grow indoors as well as outdoors. So that's actually the large project that we're trying to get done, since planting season is now behind us for a minute until mid-February.
Okay.
So all those other construction projects we're working on right now.
That's amazing. Well,
Yeah.
before we let you go, if you want to give folks a chance to understand what services you provide there at ITM Trading, where you are the chief researcher, we'd love to let you do that.
I appreciate that, because really it's what makes us different than anybody else, and that's in our approach, because it's really based, our strategy that I developed, I've been studying currencies since 1987, and I developed it based upon repeatable patterns, and it makes everything really clear. And this is a relationship. When you do business with us, you become part of the family. It's not just, anybody can throw you into gold and silver. That doesn't take a whole lot, but knowing and helping you understand how to use it, where to use it, when to use it, and how to execute that strategy so that you sustain your standard of living as much as possible as we go through this hyperinflation and reset. And then you are positioned on the other side of this to generate lifetime income. And also, if that's your goal, I know it's one of my goals, to leave a legacy for your heirs so that it's an ongoing thing. But that's what we're about. We're about this long-term relationship. And at the moment, because it's the only assets that I can find that are undervalued, is physical gold and silver. That's what we're recommending. But we're more holistic. This is a whole entire strategy just based upon repeatable patterns and what is the next most likely outcome. And they can see our YouTube channel because, we're keen on education. It's huge for us. So ITM Trading, YouTube ITM Trading. And of course, we have lots of talent here. And if you're working with the guys in the back, quite honestly, you are working with me too, because we are a team and we are family and we all work together. So you can reach us at 888-696-4653. We love the human touch.
We've been speaking with Lynette Zang, the Chief Market Analyst at ITM Trading. Today is Tuesday, November 13th, 2018. And Lynette, if you can give me a photo of the lovely additions to your farm or the fruits that are coming from that, we'd love to include those in the video.
Oh, absolutely. I will. Right now I'm getting lots of eggs too. So, all different colors. I love it.
Oh, you showed us those last time. Yeah, that's right. Okay.
Right.
Well, blessings to you. Thank you.
Oh, my pleasure, Dunn, again. I'll see you next time.
Very good. Thank you. Take care.